This is InvestTalk. Independent thinking, shared success.
I'm Justin Luke. Had a question today about investing in Brazil. Let's look at ticker EWZ. Want to get your take on that, seeing if you guys had any investments in here and what you thought about Brazil over, say, something like investing in Mexico, looking at other opportunities outside of the U.S. Thank you. Bye.
All right, glad you're looking at some foreign investments because I do think there's a lot of merit to many of those names. Now, Brazil has some of its own challenges, mainly political. And I have no problem owning some Brazilian assets. However, if you're comparing it to Mexico, I would go with Mexico over Brazil. Doesn't mean you can't have both, but just understand there are different sets of risks and opportunities. I think in Mexico, because of the close relationship with the United States, even though, we talked about tariffs and all that, it's pretty clear that President Trump has, I think, a better relationship with Mexico than, say, Canada, for example. And because of that tight trading relationship, a lot of energy flows back and forth, and there's just more of an intertwined economy and a more important economy, frankly, down there than Canada. And the demographics in Mexico are fantastic. A lot of young people. The skill down there is better than a lot of countries, and so I just think there's a lot of, and there's more political stability, even though we have the cartel issue and all of that. That is, it's more of a corruption thing that, frankly, a lot of countries have to deal with. Even countries like India, have a lot of corruption issues. So I think those are things that can be worked through. Brazil, I think their political situation is a lot more volatile. So that brings an extra layer of risk involved. Once again, doesn't mean you don't invest in it. I'm just giving you kind of comparing and contrasting the two between Mexico, since you mentioned it, and Brazil. But I think it is a good place to look. It is a more of a petro state because they do export so much oil and Petrobras. And it's going to be really driven by commodity prices. So not just the oil, but commodities in general. Large country, a lot of natural resources. They export a lot of it. And so in many ways, it's going to be correlated with commodity markets. And so, the Brazilian market is strengthening. I am seeing some good relative strength recently. So I like that. So having some exposure in Brazil, I do think is a good idea, but I would have a bit more in Mexico. Now, let's take a look at a fresh question from the comment section over on the InvestTalk YouTube channel. And Isaiah Tipton says, hey, InvestTalk, what do you guys think of ODFL after this past sell-off? What's a good entry point? Now, first off, I have to say, I like this company. This is Old Dominion Freight Lines. It's the name that's on the watch list. The problem is that this is a logistics company, a transportation company. It's a trucking company. And if there's less imports, right, the imports from China are down 60-ish%. And global trade, it means less shipping. Lower global trade means less shipping. And that's going to manifest here in the coming quarters. So, I think there's support around the 140 level. So you're getting there. But I would just be very patient on it. The technicals are poor. I would continue to have it on your watch list. It's not something I would jump in right now, especially with the weakening trade that's happening worldwide. So keep on your watch list. Great company. Should be on everyone's watch list, but not the time to jump in quite yet.
Hey, Justin. Seems like a timely call. I called in, did not even know you were talking about gold.
Mm-hmm.
I was watching your YouTube video this past weekend, which is one of my favorites of the week, always. And noticed that you said it's a good time to maybe take a break from gold. I was thinking about consolidating some of my positions. I decided I want to keep in precious metals and Eagle Mines and maybe cut Newmont Mining. I was hoping you can actually take a look at the chart for me because I was thinking, should I sell out now because gold is overbought? But looking at the chart, it seems like it's hitting some resistance and might break through. Hoping you could take a look at Newmont chart for me, please.
Yeah, I mean, it's definitely hitting that resistance from its October highs, but it's just kind of consolidating here, and to me, it looks like it's gaining power to head higher. And I don't want to get too bearish on gold. I'm just things. There's flags that make me say, okay, this has moved pretty far. It's getting a bit of a crowded trade. It hits the cover of Barron's. There's just signs that I've been doing this for 25 years, that it doesn't mean that gold has to turn around and go south by 20-30% from here. No, it just means that it probably needs to take a breather. A 5-10% pullback would not shock me. A consolidation and choppy period for the miners for a little bit would not shock me either. Just saying that if you see some near-term weakness, don't freak out about it and think that everything's going to hell in a handbasket just because it's not going up 10% a month now. It might have a down 3% month, and that's frankly, that's healthy. Like I said, this is Newmont has been chopping here around the mid 50s for now 2 weeks, and that's healthy. It's there's nothing wrong with it. There's no reason to I think sell out of it. To be honest with you, I would probably continue to hold it. If you want to, how many names do you have?
These three.
Three? Okay.
Green precious metals, AEM, and NEM. Yes.
I see no reason to consolidate it. What is your total allocation to these three names of your portfolio?
It's about 24%.
Okay, so that's a little on the high end, but I think overall that's okay in this environment. To me, it'd be more of do you want to trim that down? This would be that period we want to do that, right? Trim that down, maybe bring it down to 20, rebalance some of the positions. That's the way I would do it. I don't think you need to. Three names I'd rather have a little bit more diversity there. All three of those are solid names. We own two of those three for our clients. So, I have no issue with owning all those three. It would just be more of maybe right-sizing that for your overall portfolio, doing a bit of rebalancing at this time. That's the way I would think about it. So I would continue to hold Newmont. It would just be more of a rebalance of your portfolio.
Thank you.
No problem. Thanks for the call. Let's go talk to Sammy from San Francisco, looking at Google.
Hi, thanks, Justin, for taking my call. I would like to get your opinion on Google. Do you think this is a good price to get in, or I should wait?
I'm still pretty bearish on the Mag 7 overall, and Google is definitely one of those names that I have mixed emotions. Long term, I like a lot of their properties, mainly YouTube and Waymo. Waymo is, I think, well ahead of Tesla or any of the other driverless car systems that are out there. It's obviously been tested in many roads, especially in the Bay Area. And so I think there's some strength there. Google is probably the second best streaming platform behind Netflix, and there's a lot of strength there. Obviously, we're on YouTube, and there's just so many content makers there, and it's relatively free for Google to have and support YouTube. So I really like those platforms. My biggest issue, though, is that's not where most of their revenue is coming from right now. It's search. And they're implementing AI into their search. And they're not seeing a strong degradation of their search activity. But in an environment where the economy looks to be slowing, these businesses are going to have a lot more trouble importing their products from overseas, making a true business case if their costs go up. And that means a lot of those companies are going to trim advertising. And that's where most advertising is now, is online. And obviously when you're the leader like Google, same with Meta, right? Those are kind of the two of the Mag 7 that are going to be most exposed to an economic downturn overall, because it's so heavily reliant on advertising. So that's my biggest issue with Google right now, and why I think it continues to be on the sidelines because of those kind of economic headwinds that I think it's facing. And you can see that with earnings expectations. The market didn't really go gangbusters over the recent earnings announcement. Revenues are up 12%, which was in line with the previous quarter, and earnings growth decelerated, and that's before Liberation Day. And so analysts only expect a 14% growth next quarter, and down to single digits by the fourth quarter. So, or excuse me, so by the third quarter. And the technicals remain poor. It was the 50-day moving average yesterday on Friday, and hasn't been able to hold it. It was down today with that relative weakness. So, name that continues to be a watch for me. I wouldn't be buying it right now. Let's talk about the economic impact of these tariffs and the IMF's latest World Economic Outlook released on Tuesday. So last Tuesday, looked at and warned about the instability that is hammering international trade that would eventually hit growth. And the biggest issue that most outside the country have is that they don't really know what the Trump administration wants. And the finance minister of the Netherlands, for example, said, right now we're going through a fog. Says, what does this administration exactly want? Do they want a new trade deal? Do they want tariffs? We just don't know. And so that uncertainty and that fog is what hangs over the global economy currently. Now, even though Scott Bessent recently said that America first does not mean America alone, I want to say Joe Biden said that. So I remember there was a politician on the left that said that on the campaign trail. I think it might have been Harris. I'm not sure, but it was interesting that he said that. So there's a lot of kind of contradictory statements coming out of the White House, and that makes this a difficult race to handicap. Now, we know Trump will be the final arbiter of these trade deals. And, he talked about there's these very important ones. There's about, 16, 18 that are very important. And he looks to get these done over these 90 days. Now we're 30 days in, roughly. So, we have another 2 months. But remember that the last USMCA deal between Mexico and Canada in Trump 1.0, that took 18 months to hammer those trade deals out. So that's the hard thing here is how are they going to get through all those deals? And then what about China? Because China is clearly the most important. China and Europe, but mainly China, right? Now, the IMF has growth projections. And in January, they predicted that global growth would be 3.3%. Now they expect it to be 2.8%. Germany is expected to go from 0.3% growth to 0. And Capital Economics, consultancy firm, they had the Eurozone GDP forecast down to near 0 for Q2 and Q3. And then the US has been cut from 1 to 1.8% from 2.8% for the year. And the odds of recession are now 2 in 5, so about 40%. That's according to the IMF. Then there's the Peterson Institute. This is a more right-leaning think tank in Washington. And they have growth for the US at just 0.1% for the year. Now, if you look at shipping, German shipping giant said that last week, 30% of its sailings to the US from China were canceled. And China makes up 75% of the dolls, tricycles, scooters, other wheeled toys delivered to the US consumer last year. So the toy industry is certainly going to be hurt by this. And then Procter & Gamble, Pepsi, Colgate-Palmolive, Kimberly-Clark, they all cut their sales and profit forecasts, mainly due to deteriorating consumer confidence and obviously higher costs. And they're already seeing slowdowns in Europe and the US. Now, if you believe Apollo is a big hedge fund. Their expectations are a recession by the summer. What they see is that by early and mid-May, container ships to the U.S. ports will mostly stop. And then you have trucking demand grinding to a halt by late May, early June. And then layoffs in the trucking and retail industry create a recession in June. So that's their expectation. You're already seeing the difference between 12-month earnings per share revisions that are higher or lower head to levels that we have not seen since COVID. So it's about negative 50%. So if there's 20% are upgrading EPS, 40% are downgrading EPS effectively. And new order outlook for all the different ISM, Richmond Fed, Philadelphia Fed indexes, all of that. Those are almost all in negative territory now. The only one that's in positive territory still is Kansas. We have Richmond, Dallas, Philadelphia, New York, and the broad ISM new orders index, all in negative territory. You have U.S. corporate CapEx plans also dropping as well. I always talk about C plus I plus G plus X. I is that investment. That's CapEx. If the companies are not investing in their business, that will hurt GDP overall, which translates into earnings on Wall Street. And then you have PCE index, Fed manufacturing surveys. Those are headed higher, closer to about 4 to 5%. So you're getting that stagflationary environment. So that's what we're seeing, the impact so far. You have the Beige Book that was saying things like warning about pervasive international trade problems. And, it's not showing up in that hard data entirely. You're starting to see some of it, like I said, a lot of it's survey related, but you're most likely to get that data hit sometime in May. Let's keep things moving and play another fresh caller question.
Hi, this is Dan from Walnut Creek, and I had a question on a stock symbol JEPQ. It's JP Morgan Nasdaq Equity Premium Income Fund, or ETF, excuse me. My question is, what is this exactly? And then I'm wondering, with the individual stock holdings I see, I don't understand how it can pay out an 11% plus dividend. The last question is, does this dividend fall under the lower tax rate because it is an ETF versus an individual stock? Thank you.
All right. This is the JP Morgan Nasdaq Equity Premium Income ETF. JEPQ is the symbol. And this is one of those covered call ETFs. And this is the perfect example. All of these covered call ETFs, you have to throw out the dividend. The dividend does not matter. Ignore it. Throw it out. You have to look at total return. Okay. Total return. And let me look at if these dividends are qualified or not. Yeah, I believe they are qualified. I'm actually not 100% sure if they're qualified, to be honest with you. I do see them viewed as income, but I'm not sure if they're qualified. I'll have to double check on that. But basically here, this is following the NASDAQ 100. So it's owning the NASDAQ 100 stocks, and it is selling covered calls on top of that. Now, in a down market, that is a good thing. It hedges on the downside. In a choppy market, it tends to be good for overall returns. But it's not always. It depends on how it is executed. So, for example, the Qs so far this year, down 7.4% on the year. JEPQ, down 6.89%. So, a bit better. The problem is, last year, the NASDAQ was up 25.58%, and JEPQ was up 24.9%. The year before that, NASDAQ was up 54.85%, JEPQ up 36%. Okay, and that is total return. That includes the dividend. Okay, so you're not adding the dividend on top of that. This is all inclusive of the dividend. So what you can see over the last it's about 2+ years, right? Two years and 4 months. It's generally underperformed the Qs. So it's a lower risk way to get exposure to the Qs, but it's always about the underlying asset. Are they doing well? Or are they not? And to me, I wouldn't own this because I think the Qs are going to struggle in a time of deglobalization, regionalization, higher interest rates, lower price of the dollar, value of the dollar. And so I wouldn't be owning this because I don't like the underlying assets. Now, real quick, let's fit in another listener question from our InvestTalk YouTube channel. Matan B says, "Hi InvestTalk, I'm looking to expand my international exposure. I currently hold ETFs focused on Europe, India, and Mexico, and I'm now considering FLJP for exposure to the Japanese market. I'd love to hear your thoughts on both Japan's market outlook and this specific ETF. Thanks so much for all you do." All right, Japan. It is a country that is moving out of its economic malaise that it's been in for, decades now. I remember their real estate bubble in the 80s that burst and it caused a lot of economic harm, very similar to R08. They handled it probably in a pretty bad way. They consolidated a lot of those banks instead of allowing a lot of them to go under. And we did something similar, but not as extreme. And so it's taken some time for them to kind of reform their system. Obviously, they have demographic issues. That's a problem. They have issues with the fact that they're, series of islands and they don't have a ton of natural resources, especially energy. That's why they have a lot of nuclear power stations and they import a lot of natural gas, etc. So they have their challenges, but they also have a lot of good IP and great businesses. And in general, their economy has been improving. And they're starting to get off the zero bound. They're starting to raise rates, strengthen their currency a little bit. And that's helping their stock market. So I like that you are looking at exposure there. This is the Franklin FTSE Japan ETF. 9 basis points is the expense ratio, and that's good. That's very cheap, and that's a 3 out of 5 stars on Morningstar. And your top holding is Toyota Motors, then Sony, Mitsubishi, Hitachi, Nintendo is up there, Keyence is up there. So a lot of very, very strong businesses. So I like this. I think you should have some exposure to Japan. And this is a good way to do it. Thanks for the question. Now, lastly, let's talk about let's get an update on the returns from foreign markets versus the US market this year. Now, the MSCI USA index lost 11% in the first 16 weeks of the year, whereas the MSCI All World ex-US benchmark was up 4% in dollar terms over that same period. That's the biggest gap on Wall Street since 1993. Remember, 93, we were battling a recession, and the opposite of what's happening now, trade liberalization, was actually helping a lot of these foreign markets. In Europe, the gap has been decent. If you look at the German DAX, its index is up 20% in dollar terms this year. And that's because they're talking about opening up their balance sheet and spending, try to stimulate their economy in a world that is entrenching. The France CAC 40 up around 12% on the year. So those are some of the stronger markets that are out there, and capital is flowing towards Europe. Mainly I think this has to do with strength of institutions, governance, and that stimulus. Okay, those are the 3 factors here. The United States has always been a place of strong institutions, of corporate and federal government that has governance that is sound, that has some basis in stability. And I think the market, this is the market sending the message that the chaotic nature of these tariffs and the first 100 days of the Trump administration is certainly hurting that view around the world. And so the second best place you go is Europe. And that's probably why money is moving there. Now, Asia's doing fairly well also. China's up about 10%, the Hang Seng, mainly based on the DeepSeek news, the AI models. That's when things started to get a bit better in China. But money is mainly moving to Europe, and I think that will generally continue as long as this trade chaos continues. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And keep in mind, if you need help better understanding your risk tolerance level and how your portfolio is aligned in this market environment, I encourage you to head over to investtalk.com and schedule a free portfolio review. Now, we're just 2 days away from our free InvestTalk Wealth webinar. It all happens online at 1 p.m. Pacific time this Wednesday. So head over to investtalk.com and register. Independent thinking, shared success. This is InvestTalk. Good night.